Bitcoin often exhausts conviction before it rewards it. The market grinds sideways, patience erodes, and fear replaces confidence. But this phase isn't about price, it's about positioning. While many still cling to old 4-year cycle myths, Cathie Wood points to a new driver: institutional infrastructure. According to her, BlackRock isn't trading headlines, it's building access, liquidity, and capital pipelines. That quiet structural shift, not hype, is why BlackRock may ignite Bitcoin's next rally. The accusations are predictable: secret dumping, hidden manipulation, a master plan timed for early 2026. Every on-chain transfer becomes evidence. Every ETF flow becomes a clue. The narrative writes itself before anyone pauses to ask whether it actually makes sense. But BlackRock does not need a conspiracy to move markets. BlackRock moves markets by building infrastructure. When an institution of that scale creates a highway into an asset, the flows become the story. The noise is just the exhaust. If there is a secret plan for Bitcoin in 2026, it is not dramatic. It is procedural. And to understand it, you have to start where the narrative quietly shifted, with Cathie Wood and ARK. Cathie Wood has been clear that the old cycle framework is losing relevance. When she says the 4-year cycle may be over, she is not claiming volatility disappears. She is saying the engine has changed. The halving used to be the metronome. Now it is the background rhythm. Her reasoning is structural. Bitcoin is no longer traded only by retail chasing momentum. It is increasingly accessed through regulated vehicles, long-duration funds, and institutional mandates that think in years, not weeks. That stretches time horizons and changes behavior, not because risk vanishes, but because capital matures. That is why ARK deploying 9 figures into Bitcoin during widespread hesitation mattered. It was not a call to chase a bounce. It was a declaration that fear was mispriced. In that framework, a bottom is not a capitulation candle. It is a zone where patience quietly outperforms panic. That mindset matters because it frames everything that follows. If the cycle narrative is weakening and institutions are treating Bitcoin like a macro asset, then BlackRock becomes unavoidable, whether anyone likes it or not. Not because BlackRock controls Bitcoin, but because BlackRock controls distribution. It controls how capital accesses exposure, how risk is packaged, rebalanced, hedged, and redeemed. It controls the pipes, and in markets, pipes matter more than opinions. This is where the obsession with a secret plan starts to distort reality. When Bitcoin moves from cold storage to Coinbase, the conclusion is immediate: dumping, losses, manipulation. A premeditated collapse is scheduled for early 2026. The story feels satisfying because it gives fear a villain. But ETFs are machines, not personalities. When investors buy ETF shares, Bitcoin must be sourced and custodied. When investors redeem shares, Bitcoin must be unwound and settled. That requires transfers. That requires movement. Sometimes it requires touching exchanges. None of that implies conviction or betrayal. It implies plumbing. BlackRock does not need to sell Bitcoin the way retail imagines it. Its role is to facilitate entry and exit. Coins move because the machine moves. So if there is a plan for 2026, it is not a coordinated dump. It is a framework. BlackRock can continue normalizing Bitcoin exposure across traditional portfolios, quietly expanding the base of holders who never tweet, never panic, and never chase green candles. This kind of adoption does not show up as hype. It shows up as persistence. BlackRock can deepen liquidity by refining ETF mechanics so large inflows and outflows do not destabilize the market. That does not suppress price. It changes how price behaves. Volatility gets absorbed instead of amplified. And most importantly, BlackRock can help transform Bitcoin from a narrative-driven asset into a standards-driven one. When Bitcoin becomes something advisors can recommend, compliance teams can approve, and institutions can rebalance into without friction, demand stops being emotional and starts being structural. That idea unsettles people because structural demand does not care about feelings. This brings us to scarcity, where Plan B's worldview collides with institutional reality. The argument is simple. Bitcoin is scarcer than gold and real estate, yet valued far lower. That imbalance in this view is not philosophical. It is a mispricing waiting to resolve. Recent selling pressure does not disprove scarcity, it obscures it. Leverage, forced liquidations, and short-term distortions mask a deeper imbalance. Scarcity does not disappear because price stalls. It accumulates silently. Critics respond that markets can ignore scarcity longer than anyone expects. That is true. But history also shows that when scarcity finally asserts itself, repricing is rarely gentle. Here is where BlackRock quietly reinforces the scarcity thesis without ever endorsing it. When institutions turn Bitcoin into a standard allocation, scarcity becomes more powerful, not less. Because demand stops being ideological and starts being operational. Skeptics counter that Bitcoin does not exist in isolation. They argue scarcity must be measured against substitutes, and digital assets are infinite. This forces a necessary distinction. Scarcity alone is not enough. Scarcity must be paired with standardization. Gold is not valuable only because it is scarce. It is valuable because it became the standard store of value for centuries. Bitcoin's challenge is not proving scarcity. It is proving it deserves the standard. That is where BlackRock's role becomes pivotal. Michael Saylor approaches this from a different angle entirely. He does not debate scarcity. He operationalizes it.
I think it'll remain volatile because it's a 24/7, 365 global asset. You can panic sell it on Saturday night. You can enthusiastically buy it on Sunday morning. That's a feature. That's not a bug.
Yeah, you've lived through some of the swings, but do you think we won't see the downturns like we've seen in the past just because of the changes we've seen?
I think it's going to surge through the roof, and then it's going to surge to 180 and crash to 140, and people will be freaking out about it again.
Saylor treats Bitcoin as a force, not a trade. Volatility is not a risk to be eliminated. It is the feature that creates opportunity. He has said Bitcoin could surge violently, crash violently, and terrify investors again. That is not a flaw. That is the cost of admission. His analogy to fire is telling. Fire was once feared and destructive. Harnessed correctly, it became civilization's engine. Bitcoin, in his view, is no different. This philosophy drives his corporate strategy. By leveraging equity and convertible debt to accumulate Bitcoin, Saylor has removed short-term price fear from the equation. Drawdowns become acquisition windows. Volatility becomes leverage. Time becomes the asset.
I'm thinking that the next $50 billion won't get me 3.2. It'll probably get me 1% or less. And I'm thinking if I come up with a few hundred billion, I might, what I've said is if we get to 5% of the network, Bitcoin's going to be $1 million a coin. If I get to 7.5% of the network, it'll be 10 million a coin. So think of it as I'm buying something getting exponentially more expensive using exponentially more money. And where do we top out? I think we top out between 5 and 7.5%, and then we just exponentially slow down.
Whether one agrees or not, Saylor has forced the market to take corporate accumulation seriously. He has shifted the Overton window. Place Saylor next to BlackRock, and the contrast is clear. Saylor is an evangelist. BlackRock is a distributor. Saylor converts believers. BlackRock converts portfolios. That difference explains why BlackRock feels secretive. Retail is used to narratives. Institutions are used to processes. Jack Mallers pushes the story further out, beyond charts, and into the structure of global savings. His claim is not about near-term price. It is about market size. Hundreds of trillions of dollars sit in savings instruments designed to preserve value. Bitcoin's footprint in that landscape is tiny.
Do you see the price of Bitcoin heading?
Higher.
How much higher?
A lot higher. My general framework from the highest level is human beings collectively, we own about $900 trillion worth of stuff. That's equities, the things behind us, real estate, precious metals, fine art, all of the things that we own. Half of that we're using as a savings account. We're owning the portfolio of companies or the art or the house to actually try and persist wealth into the future. I think Bitcoin's going after that market. It's going after a market of $400 to $500 trillion worth, and right now it's $2.5 trillion. So I think in purchasing power terms, Bitcoin can go up 100 to 200 times more from here.
From this perspective, Bitcoin is not competing with equities or commodities. It is competing for the role of monetary foundation. If it captures even a fraction of global savings, repricing would not be incremental, it would be exponential. Mallers frames Bitcoin as a potential reserve asset in a world slowly recollateralizing away from government debt. His firm's accumulation strategy reflects that belief.
Bitcoin's compound annual growth rate over the last 5 to 10 years, call it 50% a year. An easier way to conceptualize that level of growth is it doubles every 18 months. People want to create a cash liquidity event with their Bitcoin without selling it, without having a capital event, a capital trigger on that. And so the fact that there isn't a market for them to borrow against it, for different credit products, lines of credit, termed loans, we think we can live in that space. We are shocked that this is a $2 trillion asset class going on what we believe to be 20 trillion and 200 trillion. And there are fundamental financial services that no one of our scale and size is focused on. Right? We look at a Coinbase and we're like, what a successful business, you know, in earnings and in net profit. But nobody's focused on Bitcoin credit. And we look at a strategy, acquired a lot of Bitcoin, but nobody's building products. And so again, it's this financial services where we fundamentally believe Bitcoin will be the next reserve asset of the world. The world has to recollateralize itself on something because it doesn't look like it's going to be treasuries and government debt. And so we think they're going to need tools.
Combine that vision with BlackRock's distribution power and the so-called secret plan becomes clear without becoming sinister. The real plan is normalization. Bitcoin is being transformed into a compliant, liquid, and routine portfolio asset rather than an emotional trade. As institutional pipelines mature, scarcity becomes structural, not rhetorical. With liquidity, regulation, and infrastructure converging toward 2026, market moves will reflect system mechanics, not conspiracy. BlackRock's role is enabling institutional access, not secretly steering price. That mechanism is the gateway. That gateway is power. Bitcoin's sideways grind is not failure, but transition. As retail cycle narratives fade, institutions like ARK and BlackRock are reshaping Bitcoin through structure, liquidity, and distribution rather than hype. Volatility remains, scarcity is unresolved, and adoption is becoming procedural. The confusion in today's market reflects friction from Bitcoin outgrowing old frameworks, not weakness in the asset itself. As we wrap up, do you think Bitcoin is being manipulated, or are we just watching an asset transition into something bigger than retail understands? Let us know your thoughts in the comments below. Share this video and hit the like button. Thanks for watching, and don't forget to subscribe.